Say that nobody rings a bell at the top. And that saying relates to the stock market, investors. There's never a clear warning sign, supposedly, of when to get out. But my experience is actually the opposite. I think there's a lot of bells that get rung, not necessarily at the very top, but certainly close to it. It's just that they're ignored, or if they're heard, they're rationalized away. Another such bell was rung overnight. We had a Bloomberg report early this morning coming out of China that the Chinese government was going to stop buying U.S. treasuries. Now, this is potentially an ominous sign because A, China is the largest buyer and owner of U.S. treasuries in the world, but B, we just cut taxes, right? We cut taxes and not spending, so we are financing these tax cuts by borrowing more money, by running bigger deficits, by selling more bonds. And if the largest buyer and owner of those bonds is saying no mas, well, then that is a big problem, because who is going to step up to replace the Chinese? But also, if the Chinese aren't going to buy, who else isn't going to buy? I mean, why would anybody want to buy U.S. treasuries? I mean, even if you didn't harbor the gloom and doom type perspective that I do, right? If you're just your typical investor who's just looking at historic bond prices, why would you want to buy U.S. treasuries now? I mean, aren't there other assets that you would rather own than extremely low yielding U.S. treasury bonds? So if the Chinese don't want to buy, it stands to reason a lot of other people don't want to buy either, especially if they know the Chinese are not buying. But of course, if the Chinese are not buying, does that mean they're selling? I mean, if they don't think treasuries are worth buying, well, are they worth owning? You would think that if they don't want to buy anymore, that means that they want to sell. In fact, when Wall Street puts a hold on something, that means sell, right? So if China is putting a hold on U.S. treasuries, that means get the hell out of U.S. treasuries, because the Chinese want to sell. And of course, they're probably not going to want to say that they want to sell if that's what they want to do. I mean, it's even amazing that they would acknowledge that they're not going to buy anymore. Maybe somehow that slipped out. And who knows, they may even deny that. But that would make sense, because you don't want the price to go down if you want to sell. I mean, if you're just going to stop buying, then I suppose it doesn't really matter. You could just hold your treasuries till maturity. And that's another thing. The Chinese don't have to necessarily sell their treasuries. They just let them mature. After all, that's what the Federal Reserve is claiming it's going to do with its own balance sheet, right? It's going to shrink its balance sheet, in theory, by not rolling over maturing securities. Well, the Chinese government can do the same thing. Hey, if they're saying they're not going to buy anymore, that might mean that we're not going to replace the bonds that mature. We're just going to ask for our money back. Well, where is government going to get it? Where is the U.S. Treasury going to get China's money back? If China's not going to loan it to them again, if the Federal Reserve isn't loaning it again, where are they going to get the money? They can't. They can't get it from anywhere. That is the problem. It's amazing how few people are worried about a problem so potentially ominous as this one. Remember, nobody was worried about the 2008 financial crisis, right? Nobody, I mean, you could turn on financial television, look at all these experts, and nobody was worried. I was the only guy. And to the extent that I said anything about what was going to happen, I got laughed at. Now, you don't even have that. I even remember, too, some of these stations, Fox or CNBC, when they were criticized about all their coverage of how great everything was in '06 and '07 and '08. And they said, hey, why didn't you warn anybody? Why didn't you have any coverage? They would actually point to the fact that they had me on. They would say, well, we had Peter Schiff on. So it wasn't like, we didn't have anybody on that was saying bad things were going to happen. Well, they're not going to be able to say that next time, because they don't have me on anymore. They don't have anybody on, really, that is pointing out what should be obvious to all their other guests. But all their other guests are missing an even bigger crisis than they missed before. Again, what was the financial crisis about? It was about too much debt, right? People took out too much debt. Well, we got even more debt now than we had then, and a big problem was rising interest rates. Now, when it came to the financial crisis, the housing crisis started that. And what happened there? And I pointed this out for years, and it had to do with teaser rates. People were buying homes that they really couldn't afford, but they could afford to make the payments on the teaser rate. They had an introductory rate for the first couple of years. They had very low payments. Now, after a couple of years, the prices were going to reset, or the rates would reset to a level that was much higher and to levels that most buyers couldn't afford. And I was pointing out that the reason people were buying houses knowing that they couldn't pay the mortgage in a couple of years was because they thought the price was going to go up. And they would profit. They would refinance into another loan with another teaser rate, or they would just sell their house and cash in on their guaranteed profit, because after all, real estate could only go up. And so I knew that eventually higher payments on mortgages were going to prick this bubble. And that is exactly what happened. Well, that's what's happened now, only on a bigger scale. The United States Treasury has a teaser rate on a $21 trillion national debt. And what the Chinese are saying with this bell that they're ringing is that that teaser rate may be expiring soon. And interest rates may be going back to normal. In fact, not only back to normal, they're going to go much higher than normal. Because first of all, when you have a pendulum, right, it doesn't stop in the middle. When it goes all the way to one side and then it swings back, it goes in an equal distance to the other side. So if we're going from ridiculously low interest rates, record low interest rates basically, we could go to record high interest rates. Or even if we don't go to record high interest rates, at least historically high, right? We can go from being historically low to being historically high. But if we only go to being historically normal or average, that is a catastrophe. You see, the people who are ignoring this problem, they have to assume that interest rates will never normalize, that these ridiculously low interest rates that we have are going to stay here forever. Now, that seems to be a crazy assumption, right? What's more crazy? To assume that interest rates will eventually go back to normal, or to assume that they're never going to go back to normal. But that is what you have to assume, the latter. You have to assume that interest rates will never normalize in order for you to not acknowledge that we're headed for a major economic crisis. Because what happens if interest rates normalize? Well, everything collapses. Just like people couldn't afford payments on their subprime mortgages when their teaser rates expired, the U.S. Treasury cannot afford to pay higher interest rates on the national debt when their teaser rate expires. And it can expire very quickly. Sure, in response to China's announcement, the Treasury bond market was initially down. It managed to recoup most of its losses, early morning losses, but yields still edged higher on the day. Bond prices are lower, and bond prices have been falling and yields rising. Now, there's a nice steady trend. If you look at the 30-year, we're just at 2.9%. We were at 2.7% in late December. On the 10-year, we're now up to 2.55. We were at like 2.1 in September of last year, but in December, we were about 2.5, and now we're 2.5. So that's a meaningful increase. But if you look at a chart, we could have an explosive increase in interest rates, which is going to be an enormous tax hike on the U.S. economy, on the U.S. government, which is much bigger than the tax cuts that the Republicans just passed. I've been talking about this, the impact, the drain on the economy of rising interest rates. I mean, if falling interest rates were helping the economy, wouldn't a rise in interest rates hurt the economy? You better believe it. Also, it's not just interest rates. Look at what's happening to oil prices. I've been talking about that. Oil prices now hit a new high for the 4 years. I think 63.54 was the high earlier this morning. I think we ran out about 63.30. But we took out the resistance. I said there was some resistance at 62.75. And a close above that, I think we could see a quick move up to $80 oil. Nobody really believes this bull market. Almost all the coverage I'm reading are about how these oil prices are unsustainable above 60, that the price is going to come down. I don't think so. I think we're now climbing a wall of worry, and I think we're going to start climbing it more quickly. The dollar is headed down. Again, the dollar sold off as a result of this China announcement. It recouped some of its gains, but still negative on the day. We're still holding above a 92 handle, but we won't be at a 92 handle for long, particularly against the Chinese currency. I mentioned in my earlier podcast, I expect the US dollar to hit a new all-time record low this year against the Chinese yuan. We had the biggest drop in 9 years last year, and I think now the dollar is poised to fall to a record low. And that would make sense, right? If the Chinese know their currency is going to be appreciating, why would they want to buy US treasuries? It's a guaranteed loser. I mean, it's a guaranteed loser for everybody to buy US treasuries. But how do all the people who justify the Dow at 25,000, how do they do that? They justify it by relating it to interest rates. They say, well, the market is not overvalued if you compare it to the bond market. Yeah, but the bond market is at a record overvaluation. How can you say stocks aren't overvalued when they're compared to bonds when the bond market is a bubble? Because what you said is, well, if the bond bubble pops, then the stock bubble is going to pop too. And that is exactly what we are staring at. Yet you have these warning signs, just like we had in 2007. Look, I had been warning about the housing bubble and all the problems that the Fed was creating by inflating that bubble in 2002 and 2003 and 2004 and 2005. I saw it coming from a mile away. And I was warning about it so often and for so long that by the time we got to 2007, right, nobody believed me. Oh, Peter, you've been saying this stuff for years. But you know what happened in 2007? All this stuff started to happen, and still nobody could get it, right? You had the bankruptcy of Lehman Brothers, bankruptcy of Bear Stearns. You had a lot of these subprime lenders that were going bankrupt. You had the whole subprime implosion. Yet in 2008, after all this stuff had happened, in early 2008, everybody was like, nothing to worry about. I was still getting laughed at. You look at my CNBC or Fox appearances from 2008, after so much of what I had predicted had already come true, and they're still making fun of me. They're still laughing at me. Oh, Peter, you don't know what you're talking about. And I would point out all these things that had happened in 2007, and they would say, and so what? And nothing bad has happened, right? All the subprime skeletons are out of the closet, and nothing bad has happened. You've been coming on these shows, warning and warning, and yes, all these bad things about, and nothing has happened. The Dow is fine. The economy is fine. The problems are contained. It's a tiny problem in subprime. But this is what these guys were saying. This is how I feel now, because so many of the things that I have been warning about, right? The problems we're going to have in the bond market, the problems we're going to have in the dollar, problems we're going to have with inflation, they're all just getting ready to get started. This is the beginning. So this, to me, in my mind, is 2007. 2007 is where everything I was saying for years got validated. Now, of course, we didn't have the collapse until 2008 of,